Look, over the last 20 years investing and the last 8 years running a mortgage broking business, I've watched people get completely distracted by rate headlines, and it costs them years. Not because rates don't matter, but because most people misunderstand what rates actually do, what they don't do, and where the real levers are if you're trying to build wealth through property long term. So in this video, I'm going to give you a simple mental model you can use in any market. Rising rates, falling rates, flat rates, and you'll know exactly what matters, what's noise, and how to make decisions without getting emotionally whipped around. And obviously, I can't give you personal advice in a YouTube video, but I can help you understand the system and the difference between investors who keep moving and the ones who freeze for 5 years waiting for certainty. Let's get into it. At a system level, the RBA uses interest rates as part of monetary policy, and the main goal is very simple: control demand. When rates go up, the theory is that households and businesses have less spare money to spend. The economy cools and inflation slows down. When rates go down, demand picks back up, the economy speeds up, and inflation can rise again. But here's the key thing that most people miss. Rates don't fix everything. They don't magically create housing supply. They don't repair broken construction pipelines. They don't undo global energy shocks. They're a lever, but they're not a scalpel. And if you misunderstand that, you start making emotional decisions of headlines instead of fundamentals. Now that you understand what rates are designed to do and what they're not designed to do, the focus shifts from reacting to headlines to gaining control over the few variables that actually drive outcomes for property investors.
The market doesn't reward the smartest predictor. It rewards the investor who can hold. Cash flow is the seatbelt. Prices can wobble, but if you're strapped in, you don't get thrown out of the car. So build the deal to survive the cycle, not impress your mates this quarter.
Now, I keep seeing comments like rate rises won't fix inflation, and sometimes that's closer to true than people realize. Because inflation isn't one thing. It can come from different places. Demand-led inflation, so people spending aggressively, businesses raising prices because customers keep paying. Supply-driven inflation, energy costs, rent pressures, logistics, trade shortages, build delays, the cost-based rises, and prices follow. Policy contradictions. Governments can be trying to cool inflation with the one hand while stimulating parts of the economy with the other. That happens. So yes, rates can cool demand, but if inflation is being pushed by supply constraints and unavoidable costs, you can get this ugly situation where households feel squeezed and the system doesn't cool evenly. That brings us to the part that explains why people feel like they're living in different countries. Once you see inflation isn't one neat story, you need to stop expecting one neat outcome. And that's where control comes from. Understanding who actually gets hit by rates and who barely notices. Here's the reality. Rate hikes don't hit everyone equally. The group that usually absorbs the most pain is in the middle. Working families with a sizable owner-occupier loan, not much diversification, and not a big buffer sitting in cash. Meanwhile, people with substantial cash reserves, invested capital, high household income with low levels of debt, or retirees earning more on their capital as rates rise can be far more insulated. So you get this two-speed economy effect. One group is cutting back, stressed, feeling every supermarket price jump. Another group is still spending, traveling, and living normally. And why does that matter for property? Because asset prices are driven by the marginal buyer, the people who can still transact. If a meaningful segment is insulated, markets don't behave the way the comment section says they should. Also, as this is important, rates are considered a blunt tool because the pain isn't distributed equally. It can unintentionally reinforce wealth concentration because higher rates can benefit people with capital while making entry harder for people that are trying to get in. Now that you understand who rates actually hit and why markets can stay strong even when thousands of households feel squeezed, the next step is leverage. How to read crash narratives properly and make decisions without fear of hijacking your timeline. Quick one, if you're watching this because you're thinking about buying, restructuring, or you're unsure whether your current setup is helping or quietly holding you back, I'll leave a link below to book a chat with my team. No pressure, it's just a proper look at your numbers and your options. And brokers are typically paid by the lender, so there's generally no cost to you for that conversation. Alright, let's keep going. Now let's address the big one. The market's going to crash. A true crash usually needs a few things to stack together. Sharp unemployment rates, forced selling, credit tightening, and demand collapsing at the same time. Australia historically tends to see more slowdowns and cooling cycles, not Hollywood-style wipeouts, longer periods of low growth after periods of strong growth, often triggered by rates moving quickly, recession risk, or lending policy changes which reduce liquidity. So what's the anchor variable I watch more than anything? Employment. When employment stays stable, people keep paying mortgages. Forced selling stays low, and property markets are harder to break. When unemployment spikes, that's when downside gets real, because it's not about sentiment anymore. It's about cash flow and survival. Now that you've got a realistic filter for crash talk, the clarity you need next is how lending costs actually move, because it's not just the cash rate that matters.
If you think interest rates solve inflation, you're giving them way too much credit. Rates are just one aspect, one tool. Inflation is a machine with 50 moving parts. Just one tool can slow demand, but it can't fix supply problems, build houses, or undo global price shocks. So stop asking, what will rates do? And start asking, what can I control if rates move?
Some people get confused when they see fixed rates move even when the RBA doesn't. That's because banks price a lot of fixed rate lending off bond markets, which reflect expectations around future rates and inflation. So you can absolutely see lending costs shift because markets are repricing risk and expectations even before the RBA moves. This matters because if you're building a portfolio, you need to understand the cost of money is a moving ecosystem, not one switch. And tied into that is currency. When the Australian dollar strengthens, imported goods can become cheaper, which can ease inflation pressure. When the AUD weakens, imports cost more, businesses pay more, and those costs often get passed on, which can keep inflation sticky. And you'll often see the AUD move on expectations about rates. If markets suddenly think Australia will hike when they expect cuts, the currency can jump. This is why global trends matter even if you're buying local property, because inflation isn't just Sydney or Melbourne, it's connected. Now that you understand how money moves through the system, control comes from focusing on what actually keeps investors safe and scalable, and it's not predicting the next quarter's price chart. Historically, a manageable level of inflation tends to be supportive for hard assets like property, because replacement costs rise, rents can rise, and the debt is fixed in nominal terms. But here's the real rule that separates grown-up investing from wishful thinking. Cash flow resilience matters more than short-term price movements, because if you can hold through volatility, the cycle can play out. If you can't hold, you sell at the wrong time, and that's when property becomes painful. The same reason high savings rates can be a trap. You might earn 5% in a savings account, but if inflation is eating purchasing power and the asset that you're chasing is leveraged and rising over time, you can still go backwards in real terms. Once you lock in that cash flow is the anchor, the leverage point becomes market selection, because not all suburbs, not all price brackets, and not all property tends to behave the same in rate cycles.
Property doesn't crash when people feel scared. It happens when people are forced to sell. The first domino is employment. So when jobs are lost, repayments stop, and then assets are forced to be sold. This is when things can drop aggressively. So keep an eye on employment, not on a comment section.
Rising rate environments widen the gap between segments. Why? Because different buyers have different sensitivity to debt. The top end of Sydney, more equity, more cash, less reliance on maximum borrowing. First home buyers borrowing 90 to 95%, far more sensitive to serviceability changes. And this is where people get lazy and say, just buy affordable areas, they'll grow. Not necessarily. If you ignore vacancy rates, yields, supply pipelines, unit approvals, build to rent and high density saturation, and local employment engines, you can buy something cheap that stays flat for a long time. Oversupply risk often shows up years later because approvals and construction pipelines take time. Even if approvals don't guarantee commencement, developers can sit on these sites until feasibility improves. And trade shortages, build delays, and supply can stay constrained for longer than people expect, something that rates can't magically fix. And then you've got population growth and migration, the quiet anchor that keeps long-term housing demand supported because people need somewhere to live. Renting first and buying later, either way it pressures stock. Now that you can see why markets diverge, within the same city, control comes back to one very practical lever: borrowing capacity, and how to avoid getting boxed in by lender rules. Rate moves reduce borrowing capacity often a few percent, but the behavioural impact can be bigger than the math because it changes what buyers feel comfortable bidding. But here's what I'll say bluntly: if you're waiting it out because of fear, you can increase long-term risk. Because then the question becomes, what exact metric are you using to decide when it's safe? The problem is, by the time the data looks calm, the market has often already moved. There are armchair experts who have waited 5, 10, 20 years. And what happened? The market didn't send them an invitation. It just ran. Now that doesn't mean buy recklessly. It means don't confuse fear and procrastination driven from worrying about the repayments holding you back from building real wealth. So if rates are mostly noise for long-term investors, what matters today? These are the grounded decision filters. Stress test your cash flow. Banks use buffers, currently around 3%, but you need to be honest around your real household budget. Focus on the drivers that you can control: income, savings rate, structure, spending buffers, and the quality of the asset. Understand your lending pathway. Different lenders can assess the same person very differently. That's why strategy matters, not just rates. Respect market fundamentals, supply pipelines, vacancy, yield reality, employment base, and long-term demand. And if you do that, rate hikes stop feeling like a scary random event and start feeling like part of the weather. You don't panic because it rains. You bring a jacket. If you take one lesson from this, let it be this: rates alone shouldn't decide whether you build a portfolio or not. Property is a long-term game. The winners are the people who stay rational, build for cash flow resilience, and make decisions off fundamentals, not fear. And if you want help mapping this out properly, your borrowing capacity, your structure, and what it is actually possible from here, I've left a link below to book a chat with my team. Before you book, this conversation is only a good fit if you are genuinely looking to buy in the near term and not just waiting to see what happens. You want a structure that still works if lending tightens again. You care about building a system that buys back your time, not just owning property for the sake of it. And you are ready to make decisions based on clarity rather than fear or headlines. If you're waiting for the market to feel perfectly safe or hoping the rules go back to the way that they used to be, this is not the right next step yet. If you are ready to buy, feel free to book in and I'll see you on the call. With that being said, thank you for watching and I will see you in the next one.